Have you ever wondered why some companies build these incredible fortunes that last for generations, while others just crash and burn in the most spectacular way? Here's the thing, it's usually not about the spreadsheets or some genius market timing. It all boils down to a set of core principles, kind of like the unwritten rules that are the absolute bedrock of finance. So let's get into it, because really, understanding these rules is the key to telling the difference between a solid company and a time bomb that's just waiting to go off.
I mean, we see the headlines constantly, right? On one hand, you've got the people who are just outright fraudsters. Think about Ramalinga Raju at Satyam Computers. The guy literally just invented over $1 billion in cash on the books that just wasn't there. Or what about Elizabeth Holmes at Theranos? She built this whole massive empire on technology she knew for a fact was completely worthless. These weren't accidents. This was deliberate.
But, it's not always about some evil, mustache-twirling villain. Sometimes it's just a shocking failure to manage risks that are staring you right in the face. We saw it with the massive collapse of Island FS in India and, well, more recently with Silicon Valley Bank over in the US. I mean, these were seasoned professionals who, for whatever reason, just ignored the fundamental dangers. It's wild.
Okay, so if these massive, company-killing failures aren't just random acts of bad luck, there has to be a common thread, right? There must be some kind of fundamental set of rules that got broken again and again. So the real question becomes, what exactly are those rules?
Well, it turns out that the entire super complex world of finance can pretty much be guided by 5 surprisingly simple but incredibly powerful core principles. And these aren't just, theories you read in a textbook. These are the real-deal guardrails for making smart, ethical decisions that build actual, lasting value.
All right, first up, and this one is huge. Cash flow is supreme. You've probably heard the saying, profit is an opinion, but cash is a fact. And it is 100% true. Accounting profits, they can be fudged, they can be played with, but the actual hard cash flowing into and out of a business, that's the ultimate reality check. It's the lifeblood. It's what you use to pay your people, handle emergencies, and actually grow. Without it, you're toast.
Second principle, money has a time value. Look, a rupee in your pocket today is worth way more than someone promising you a rupee a year from now. Why? Simple. You can take that rupee today, invest it, and earn a return on it. So every single financial decision you make comes with an opportunity cost. That's the potential return you're giving up by picking one thing over another.
And that leads us right to the most basic deal in all of finance. Principle number 3, risk requires a reward. Nobody, and I mean nobody, is going to risk their hard-earned money without the chance of getting a decent return. And the more uncertain something is, the higher the potential payoff has to be for an investor to even consider it. It's really that simple.
Building on that, we get to principle 4. Market prices are generally right. See, in a market that's actually working the way it's supposed to, a company's stock price should pretty much instantly reflect all the information that's out there in the public. This is what keeps insiders from having a totally unfair advantage, and it's what builds the trust that is absolutely crucial for people to feel safe investing their money. And that brings us to our 5th and final principle. Conflicts of interest cause what are called agency problems. Now, this sounds fancy, but it's simple. It's what happens when the people running the company, the managers, start chasing their own goals, like maybe a giant bonus or more power, instead of the main goal of the business, which is to make money for the owners, the shareholders. These conflicts can lead to some truly terrible decisions that just destroy a company from the inside.
So, there you have it. The 5 big rules of the game. Cash is king, time is money, risk needs reward, markets should be fair, and everyone should be pulling in the same direction. Now let's lock these in, because we're about to use this exact playbook to figure out what went so horribly wrong with those companies we mentioned earlier. All right, welcome to the autopsy. This is where we're going to connect these 5 principles directly to the problems we saw. Think of these principles as a diagnostic kit. We're about to use them to find the precise cause of death for these corporate giants. Okay, this table really just lays it all out, doesn't it? Let's take Satyam. They broke the cash flow is supreme rule by literally making up cash. That, in turn, shattered the market prices are right rule, and it was all driven by a massive conflict of interest. What about Theranos? Well, they blew up the risk requires a reward rule by just lying about the risk. The technology never worked, so the risk was infinite. And Silicon Valley Bank? Wow, their collapse was a textbook case of ignoring the time value of money. They bought all these long-term bonds with low returns, and when interest rates skyrocketed, the value of their assets just tanked.
completely violating the risk-reward deal and triggering a total collapse. You see the pattern here? It's crystal clear.
All right, enough of the doom and gloom. It doesn't have to be this way. For every one of these disaster stories, there's another path. So let's look at the huge difference between chasing a quick, flashy profit and patiently building real, lasting value.
Man, this comparison really tells the whole story. On one side, you have Kingfisher Airlines. They went for this sugar rush strategy, borrowed a ton of money to sell cheap tickets and grab market share fast. It created this illusion of success. The stock price shot up for a minute, but the actual cash flow was negative. It was completely unsustainable. And then you have the total opposite, Tata Consultancy Services, or TCS. They played the long game. They focused on strong leadership, avoiding those conflicts of interest, and reinvested their actual positive cash flow year after year. The result? I mean, look at it. Two completely different philosophies and two dramatically different endings.
So what's the big takeaway from all of this? It's that these 5 principles aren't just for CEOs or Wall Street quants. They're for everybody. They form a practical, ethical compass that anyone in any job can use to figure out which way is true north when you're facing a tough decision.
So what can you actually do with this? Well, if you're a manager, before you make any big call, just ask yourself one question. Does this break one of the 5 core principles? If the answer is even maybe, you stop. Full stop. And if you're a subordinate and someone asks you to do something that feels wrong, please remember this. The people at the bottom are almost always the first ones to get caught. Getting fired is so much better than going to jail. Your integrity is worth more than any job, period.
And that kind of brings us to the final big question. The rules themselves are so simple, right? They're logical. Cash is real. Risk needs a reward. Be fair. Act in the owner's best interest. It's not rocket science. So why, when people and companies are faced with that pressure for a quick win or personal gain, why is it so incredibly hard to just follow them? That's the question that sits right at the heart of ethics, finance, and maybe human nature itself.